Welcome to the Alain Guillot podcast, a podcast about life, leadership, and money matters. Our guest today is Professor of Finance at Johns Hopkins University, Jeffrey Hooke. He's a longtime investment banker and a private investment executive. He's the author of 5 books, and his latest one is The Myth of Private Equity, an inside look at Wall Street's transformative investments. Professor Hooke, thank you so much for joining us today.
My pleasure. Thanks for inviting me.
I'm impressed with the amount of work that you have done, the books that you have written, and I wonder if we could start with you telling us a little bit about your background. How is it, or what is it that interests you in the field of finance, and then later on in the activity of writing books about finance?
Well, when I was in college, I was always interested in business. I started looking at being in marketing. I thought that was very creative, but I had a bit of a mathematical bent. So in college, I shifted my interest from marketing to business and finance, where, of course, as many of you know, there's a lot of numbers. And then I went from college to grad school and specialized in finance, which I think is a fascinating area to be involved with from a career perspective, simply because it changes so much. And I then left grad school. I went to work on Wall Street for about 15 years. As you pointed out, I was an investment banker and a private investment executive. I then shifted to the World Bank, where I was doing international finance in the private sector area, and then moved on to a private equity job at a gigantic private equity fund, and I did that for a couple of years, and then I switched back to investment banking, where I worked for another dozen years before I became a college professor. Now, you did point out I did write a few books along the way. They're all about financial topics, and for your listeners, it may be of interest to them because the books are written from a practitioner's point of view. Yeah, as I know the theory since I work at a university and I've written some papers with my fellow professors, but there's a lot of practical elements to the books.
And okay, so this seems to be a strange questions to ask, but a person interested in finance, I study finance as well. And when I was a little kid, I saw a few Wall Street movies and financial leverage buyouts and so on and so forth. And my dream was to become a speculator and become dirty rich. And I wonder about other people's motivation to get involved into the financial field.
Well, clearly the level of greed would be higher in finance than a lot of other professions. And I mean, I enjoyed the movies. Certainly they condensed the Wall Street experience in a couple of hours. And, what you see in the movies is like Wall Street, which I happen to like, is a far cry from what it truly is, because when real investors like private equity investors or companies that are doing mergers and acquisitions, when they consider a takeover, it's a heck of a lot of analysis and legal work. So it involves many meetings, lots of study. It's just not like you see in the movies where the takeover guy looks at a couple of pieces of paper and then tries to buy a company for $500 million. But it's a fascinating field. It's global. It changes all the time. Hollywood tries to do it justice. It's just tough.
How about, since you've been a practitioner and also an academic, how much of a discrepancy there is between what students learn in the textbooks and the real life?
The purpose of the university education in business is to prepare you for that first job in finance, whether you're at a bank or an investment bank or a big company like Exxon or Amazon. So you're not supposed to know the nuts and bolts, but it shows when you graduate from a university program in business that you know the theory, you know why a company might borrow, you know why a company has to market things a certain way, at least the theoretical side of evaluating a project or looking at your cost of capital. So you're given the foundation from which to grow. I mean, a company can't expect you to know everything the first day you start. A lot of my students ask me that, well, do I have enough practical experience? And I say, well, look, if they wanted practical experience, they can pay someone 2 or 3 years of practical experience and pay them 3 times as much as they're paying you. You know, they're hiring beginning people because they want to train them and bring them into the organization.
Okay, and before we get to the subject, I wonder how you as a professor explain financial anomalies, like, for example, the meme stock, like GameStop, and or all these things that really doesn't make sense at all. If you, from whichever point of view you see them, they're just absurd.
Well, look, you got to remember, Elaine, and many of your listeners who are a little older will remember, you know, the stock market here in the United States goes through various periods of speculative frenzy. And that's when the value of certain stocks has no relationship to their earnings, or as Warren Buffett would say, to their fundamental value. So in practice, you know, most stocks, their values are tethered to their earnings ability or to their skill at producing cash flow and dividends to the owners, the stockholders. But you know, from time to time, you have frenzies about various categories of stocks. So some of you that are older like me might remember 20 years ago when the first wave of internet enthusiasm was, and you had these wild valuations for a lot of internet stocks. I'd say 90% of which went bankrupt after the big boom of the late 90s. And then you had a real estate frenzy in 2008, 2009, where a lot of companies connected to real estate had these, you know, very sharp values, and then they proceeded to go under. I mean, we've had a couple other sub crazes, like biotech is one that comes to mind, where biotech was really hot for a couple of years, and then it crashed, like you'd see, you know, a satellite crash from orbit down into the ocean in flames. It's not too unlike that. So the meme stocks have nothing to do with say fundamental values that you would learn in a business, you know, a corporate business setting or an academic setting. Nonetheless, you know, like a tulip bulb in the 1600s, you know, they do have value. People are willing to pay for them. And when the next person is unwilling to pay for that tulip bulb or that meme stock, you know, it may have quite a sharp fall. I mean, my personal opinion is the market, including meme stocks, has been inflated for, you know, several years. And I attribute that not so much to the excitement people have over social media, electric vehicles. I think the prime instigator is that the low interest rates, you know, so interest rates are so low, it's unprofitable to put your money in a bank account. I mean, real estate values have gone through the roof, as I'm sure some of your listeners that are thinking of buying a house have discovered. So you have very few places to put your money where you think you can earn a decent return. Stocks seem to be the repository for the time being for those people that don't want to leave their money in cash or buy a long-term bond at 2 or 3%. So I sympathize with a lot of listeners that are a little frustrated or a little perplexed at the values of some of these meme stocks, but I mean, just hold on. They'll probably return to earth a couple of years, maybe. We'll see.
Okay, can you talk about a minute or two about the previous books that you have written, just to get a perspective of your work?
Okay, so, you know, why would someone like me write books? There's no money in writing books. I have to admit that. So it's a character flaw. You know, I think I have something to convey or something to educate. And so I guess it's a very unprofitable hobby. But I think that people should look at this fascinating business, and, you know, books is one way to describe it and educate people about what's going on. So my first book was about mergers and acquisitions. At the time, you know, the merger acquisition market was growing. It hadn't taken off like it has now. So I didn't really see a good book for practitioners. And so I was an unknown author. I hadn't written anything. And so a big publisher, I guess you could say, gave me a break, and I wrote the book, and it was a pretty good success. And then I saw a similar lack in the market for a sort of a practitioner-oriented book on how to value a stock or a company. I mean, the last one that really dealt with the subject in a concrete or thorough way was the old Graham and Dodd book written in the 30s. And there have been one or two updates. So I did an update of that notion of valuing a stock in the late 90s. And that was a big hit. You know, CFA Society adopted part of it. And then I did a book on the World Bank, my experiences at the World Bank, and a critique of that institution. And I'd done a book on investing in the emerging markets, which I'm not referring to social media, the internet, or high tech. International emerging markets like China or Thailand or South Africa. What's it like to invest in emerging markets? What are the opportunities? What unique risks are there? So those are the 4 books I'd written previously.
Okay, so now going to the topic of your present book, The Myth of Private Equity. Can you, to start off, describe what is private equity?
Yeah, so private equity is something you read a lot about, and you'd be just surprised at the confusion over what it is. Private equity is essentially private stock, so the stocks of private companies. So since they're private, you can't buy them on a public exchange like the New York Stock Exchange or the NASDAQ here in the United States. So you're buying stock which you hope will go public later, and then you can sell it. If it doesn't go public, you just hope that the company after a few years will sell itself in a merger so you can get your cash out. So the private equity is very similar in many respects to public equity, since there's corporate securities in companies that are seeking to make a profit. Now, there's 3 kinds of private equity, essentially. There's buyout funds, leveraged buyout funds, which is the principal focus of the book, because buyout funds are about 2/3 of the private equity business. The other smaller cousins of private equity are venture capital, which I guess you could say has a tendency for more young companies or less mature companies that haven't proven their business model. So that would be venture capital. And a lot of venture capital is high tech, but not all of it. And then there would be growth capital, which is sort of a asset class which seeks to bridge the very young companies in venture capital with more mature companies. They're not ready to go public, they're not ready to sell, but they're not quite the venture capital type business. They're more established. So that would be the growth capital. So there's three main categories, of which, as I said, buyouts are the biggest, and that's the focus of the book.
Right. So none of these are available to retail investors. They are available to institutional investors, right?
Exactly. So the government here in the United States has decided that private equity, for the most part, is simply too risky or too sophisticated for the average investor. So, a typical retail investor would say 50 or 100,000 in their brokerage account. That's not enough money where the government thinks that person can roll the dice on a private equity investment, which is going to be somewhat opaque. The fees are quite high, and they think the investor needs a greater degree of sophistication. So generally speaking, the net worth for going into private equity, supposedly with your eyes open, is a couple of $1 million. So that leaves out most of us, right? That kind of money. Now, recently the government endorsed, and I think this is inappropriate, endorsed 401k plans for retail investors to buy private equity. I personally don't think that widows and orphans and 401k plans should be allowed to go into these sophisticated high fee strategies that really don't provide great returns.
Okay, so I mean, there is a lot of uh, media coverage towards some of these private equity companies, and when they go public, uh, we feel retail investors that we are missing out. For example, when Airbnb went public, we feel like, oh, how come I couldn't get in? I mean, it went up almost 100%. How come only the big players can get in? So from my perspective, I feel like we are missing out, but you highlight that there are some negative effects on private equity. Could you just mention some of those?
Well, first, I think most of your listeners have to realize that the Wall Street IPO is built around rewarding big institutions. The Wall Street trading firms and the investment banks are going to derive most of their trading volume commissions with the big institutions. So when an IPO from, say, a private equity firm comes to market, and therefore the private security becomes public, the particular security being offered is, I don't know, 90 or 95% reserved for those institutional clients that have been working with the investment bank for years and will continue to do so. Now, you make a good point. A lot of times these IPOs seem to jump up in price. Sometimes they do that. I guess probably the majority of times they jump up in price, not all the time. And that reflects that the investment bank, the underwriters, are deliberately setting the price below the natural supply and demand number. Why do they do that? Well, one is they want to reward the institutional clients by giving them cheap stock. And two, this might be a little complicated, but the underwriter technically has some risk of maintaining the IPO price. If they set it, and it's never certain what it's actually going to be. It's always hard, because I used to do IPOs. It's a little hard to see where it's going to settle. So if you as the underwriter price it deliberately low, the chances that you will have to spend your own money to maintain the price drops accordingly.
And isn't that also good marketing as well? When a retail investor hears, oh, Airbnb went up 100%, that must be a good investment. And I'm going to buy me some stocks of that because it just has this amazing return in the first day.
Yeah, I agree with you. That seems to be the mentality. Oh, the stock popped 100%, must be a terrific company. Well, like we said, a lot of times stock prices don't reflect the fundamentals, but certainly in the case we just talked about, where a pop of 100%, that probably reflects a lot of hype and good marketing by the underwriters, not to mention whatever input retail social media has into the process.
How about positive effects? I mean, we just spoke about some of the negative effects of private equity. Are there any positive effects?
Repeat that question again.
Okay, so we just spoke about some of the negative effects of private equity. How about positive effects? What's good? What's the good side about it?
Okay, yeah, so let's, principal negative effects would be that private equity is opaque, it has high fees, and it really doesn't beat the public market. So the sales pitch that you hear a lot in the papers or on TV is basically phony. But it does have positives. From the investor's point of view, what would be a positive? I presume, one positive, you get a chance to diversify out of the public market. So let's say you are a big institutional investor, you own 200 stocks and they're all publicly traded. You might say, well, I'd like to get some exposure to companies out of the public sphere. I just think that's a good idea. That's a diversification move. The private equity allows you to do that. Whether that diversification element is worth the high fees, the fees are like 3 or 4% a year, is highly questionable. But I think it's a small benefit. Now, the private equity market's far smaller than the public markets. I mean, the private equity market I talk about is probably, I don't know, only 5% of the size of the public market. So the diversification effect is small. Now, from the point of view of companies that sell their stock to private investors, there's also a benefit. They just have another avenue of selling. So in the old days, if you were, let's say, running a paper company and your family had owned it for 50 years and you wanted to sell, you could only really sell to a competitor and get a decent price. Now you can sell to a competitor or say a buyout private equity fund, and you got more options. You're going to get a slightly higher price for the family.
You open your book talking about the Maryland Pension Fund, a $50 billion pension fund. And the returns of that fund are embarrassing, to say the least, but it seems to be that's a regular fund, something regular in many pension funds. Here I am in Quebec, and here we have the Quebec Pension Fund. And since I've been here in 21 years, only once I think they have beat the Canadian index. So I wonder how come these funds are so poor performing and no one expects anything better out of them.
Well, just to edify your listeners, as you just did, and this is a fascinating fact, probably 95% of all state pension plans, including those in Canada, United States, university endowments, big nonprofit foundations, 95% of them do not beat a simple 60% stock, 40% bond index. That's sort of a very popular measurement tool for these big institutions, a 60-40 index, they call it. So 95% don't beat it. I mean, it's a fascinating number, which I never would have thought of had I not written a book about this sort of thing. And you make a good point. Well, why doesn't anybody do anything about it? Well, the first reason is that the individuals running these funds, the investment managers for these state pension plans, which have hundreds of billions of dollars, they don't want to be measured against a standard number like a 60-40. So they never really disclose what the comparisons are. You have to do that on your own. Secondly, these same managers like their jobs to sound very complicated. So they don't really like a 60-40 index, because if the state pension fund were to convert all their investments into a 60-40 index, as opposed to all this complicated hedge funds and PE funds and commodities, then the trustees would say, well, if I got a 60-40 index, what do I need you for? What do I need the managers for, paying them $2 million a year? That wouldn't make any sense. So the managers essentially are trying to perpetuate their jobs and their compensation, their careers. So I guess that's normal in any human endeavor. You want to protect yourself. So that's the second reason. The third reason is that the trustees, if you are looking at a big pension plan, be it in Canada or the United States, there'll be, say, 12 or 15 trustees that are supposed to supervise the managers. Well, in a lot of these cases, the inmates are running the asylum. So the managers are telling the board of directors what to do. And the trustees or the board of directors generally will not have a sophisticated financial background where they can throw pointed questions at the managers. In Maryland is an example, as you pointed out in the book. I mean, half of the trustees are union leaders. They don't have any deep financial knowledge or sophistication with the market, the financial markets. I'm not saying they're stupid people. You're not stupid when you get to be the head of a union, but you wouldn't have that specialized knowledge to counteract what you're hearing from the investment managers. A few of the other trustees would be political appointees, and the ones I've seen don't have a deep knowledge as well. And then there'd be two or three people in a typical state pension fund that might be official state government type appointees, say the director of the budget or the state treasurer or something like that. And often these people have a political background, but they wouldn't have much of a investment background. So you have several reasons why the situation, sad as it seems, festers on, and these states just aren't maximizing returns and limiting fees.
Okay, so the trustees basically rubber stamp the proposals of the managers. But for example, a trustee who is a union leader, who knows that the returns of those funds are going to provide money for the retirees of their unions, why wouldn't that person recognize that his knowledge of finance is inadequate and try to, I don't know, either find somebody else who could help him understand these financial decisions, or I don't know, look for some other alternative? There is real money in the line for the union members, and this lack of accountability is hurting everyone.
Well, you're preaching to the choir. I mean, you're absolutely right. I mean, it seems like a dereliction of duty for particularly the union trustees of these plans not to do more investigation. I don't have a good explanation. Maybe they lack intellectual curiosity. I know, having talked to people on these boards, that the union members' representatives are often a little hesitant to ask questions because, the material seems so technical. They're afraid of asking a dumb question in front of 15 people on the board and the other 30 spectators sitting there in a public way. But your question is spot on, and it's a bit of a mystery to me.
Okay, and then the other question is, yes, I know that the experts will try to obfuscate their investment strategies, but at the end of the year, I mean, the public can see, okay, if I compare your sophisticated investment strategy with a simple return of an index year after year, you continue to underperform. Eventually, that people have to discover that the emperor have no clothes.
One would think in an efficient world, with a lot of rational people, what you say would occur after a few years of performance below a objective measure like the 60-40 index, that the trustees would start complaining, and then maybe the union members themselves would start complaining. But if you look at one of these state pension reports, or maybe if you look at the report of the Quebec Pension Fund or something, you'll quickly find out that the report is 150 pages long. It's written in mind-numbing verbiage that a normal person can't expect to interpret. So even for me, it's tough to flip through the pages and find those few salient facts that would reveal that the union members are getting stiffed and that effectively they're going to have lower retirements because of the investment returns being lower than optimal. But just don't see people digging. I mean, it'd be nice if you saw the media lifting up rocks and trying to find out where people are getting stiffed. I mean, I've had a few reporters in various places, Montana, Texas, who are doing investigative work and trying to put a spotlight on these, say, injustices to the union members. But that sort of thing is really far between. You don't see it happening much.
Well, you with your book, you are in a sort opening the kimono and letting everybody else see inside. I wonder if you think you will get any pushback from the revelations that you're bringing forward.
Well, the book's only been out for a couple of weeks. So, I mean, a couple of people I know who ordered the book just got a copy in the last few days. I only got my copies 3 days ago. You do need to read it first before you critique it.
Right.
So I do expect to be getting some flack from people that are promoters of the industry or true believers. And I just have to have a thick skin and try to help them see the light.
Maybe you will be less invited to dinner parties.
That's possible. Of course, here in Washington, the dinner parties would be more political types. They might pick up a book like this and have a hard time getting through the first chapter.
Okay, well, Jeffrey, this is amazing. I wonder if you could tell us one more time the title of the book and where can the listeners follow you?
Okay, so the title of the book is The Myth of Private Equity. And it just came out the last week. So you could buy it at your local bookstore or go to any of the electronic booksellers or even the publisher itself, Columbia Business School Publishing. And you buy it in a hard copy or the electronic version.
And one last question. Let's say as a regular citizen, I have an objection of how the pension fund of my province is being run. Is there anything that as a private citizen I could say or do or complain about?
Well, to get the base information from which to make complaints or judgments, I mean, like I said, you'd have to attack that 150-page annual report. You'd need someone to help you decipher it.
Right.
So I wouldn't discourage people from doing that. I would just encourage them to get a friend that knows something about investments, spend a couple of hours one afternoon looking at the report, picking out the numbers, and then maybe try to put together a short fact sheet for maybe your legislator or somebody like that who may have an interest themselves in getting a better operation out of the pension fund or pension plan management.
Well, thank you so much for your time, Jeffrey.
My pleasure, Lane. Thank you.